Welcome to the Capital Architecture. Today, we are examining the structural foundations of early modern banking by looking at the Medici Bank in 15th century Florence. While they did not invent banking outright, the Medici institutionalized several financial instruments and organizational structures that remain central to the global financial system today. To understand the operational model of the Medici Bank, it is necessary to look at the regulatory environment of medieval Europe. The primary constraint on financial markets at the time was the Catholic Church's strict prohibition of usury. Charging interest on a loan was considered a severe moral and legal offense. This created significant friction for international trade, a trade that was expanding rapidly and required reliable cross-border flows of capital. The Medici navigated this regulatory constraint through the widespread application of the Bill of Exchange, or lettera di cambio. If a merchant in Florence needed to purchase goods in London, transporting physical gold across Europe presented high security risks and severe logistical costs. Instead, the merchant deposited local currency with the Medici Bank in Florence. In return, they received a bill of exchange, a document instructing the London branch of the bank to pay the merchant an equivalent value in English currency at a future date. The mechanism that made this profitable for the Medici was the exchange rate. The payout in London was calculated using a rate that implicitly included a premium for the bank's service, covering the risk and the time value of money. Because the transaction was technically structured as a currency exchange rather than a direct loan, it bypassed the church's usury laws. This system facilitated international trade by providing secure liquidity without violating the dominant legal codes of the era. Beyond financial instruments, the Medici Bank's most significant contribution to financial history was its corporate structure. Earlier banking institutions, such as the Bardi and Peruzzi banks, operated under a highly centralized model. If one major branch suffered catastrophic losses, the financial contagion would quickly bring down the entire institution. Under the management of Cosimo de' Medici, the bank restructured into what is conceptually recognized as an early holding company. The headquarters in Florence did not directly own the branches in cities like Venice, Geneva, London, and Rome. Instead, the Medici family established separate decentralized partnerships for each branch. The central holding company provided the majority of the capital and held the controlling stake. But the local branch managers were junior partners. They invested their own funds and shared directly in the profits and losses. This decentralized structure effectively compartmentalized risk. If the London branch defaulted due to local economic downturns, its losses were contained. The Florence headquarters and the other branches remained legally and financially insulated. This allowed the Medici Bank to scale its operations across Europe while mitigating the systemic risk that had destroyed their predecessors. To manage this expansive multinational network, the Medici relied on double-entry bookkeeping. While they were not the first to invent the system, they implemented it rigorously across all their branches. By recording every transaction as both a debit and a credit, the bank's leadership in Florence could conduct precise audits, track capital flows, and maintain an accurate picture of their overall financial health. Information asymmetry between the central office and the distant branches was minimized, giving the Medici a significant operational advantage over their competitors. The bank's most lucrative and strategic relationship was with the papacy. The Medici essentially functioned as the primary financial institution for the Catholic Church, managing the collection, accounting, and transfer of ecclesiastical taxes from across Europe to Rome. This provided the bank with a massive, continuous flow of deposits and unparalleled political leverage within the Italian city-states. However, the Medici Bank was not immune to market risks and poor management. In its later years, the bank strayed from its core commercial operations, financing trade, and began issuing large unsecured loans to European monarchs to finance wars. Sovereign debt in the 15th century carried extremely high default risk. There was no legal mechanism or international body to force a king to repay a loan. Successive defaults by state actors, combined with a lack of oversight by later generations of the Medici family, led to severe liquidity crises. The bank ultimately collapsed in 1494. Despite its operational failure, the institutional blueprint of the Medici Bank survived. The mechanisms of foreign exchange, the risk management provided by the decentralized holding company structure, and the rigorous application of standardized accounting were adopted by subsequent financial institutions, first in Amsterdam, then London, and eventually Wall Street. Thank you for watching The Capital Architecture. If you found this objective analysis of financial history useful, please consider subscribing. Leave a comment below. on which historical economic system, crisis, or institution we should examine next.